It's a great day to be in real estate. This is Duane, Beisner, sales manager and sales representative for ERA. My quote of the day today: habit, if not resisted, soon becomes necessity, by Augustine of Hippo. And for the quote of the day: a devil tells a real estate agent, look, I can make you richer, more famous, and more successful than any other real estate agent alive. In fact, I can make you the greatest agent that ever lived. Well, says the real estate agent, what do I have to do in return? The devil smiles. Well, of course, you'll have to give me your soul, he says. But you'll also have to give me the souls of all of your children, the souls of your children's children. And as a matter of fact, you have to give me the souls of all of your descendants throughout eternity. Wait a minute, the real estate agent says as he thinks for a minute. What's the catch? Okay, so now, today we're not going to have any social commentary because there was a special report that came out from Lawrence Yun, who's the NAR chief economist. So I thought it was a great article I wanted to cover. There's a lot of meat to this. So he said it's certainly been an interesting past month, and it has if you look back. We've seen up and down movement in the stock market, concerns about mine safety, a potential environmental catastrophe, primary elections in many states, and the fortunately unsuccessful bomb threat in Times Square. Of course, most of these developments have little direct impact on housing. That's the good news. So let's take a look at what we do know for sure from the latest housing statistics. Home sales continued to recover in March. Existing home sales, which reflect closings, not contract signings, rose 6.8% from the previous month. That's good news. At the same time, pending home sales rose 5.3%. More good news. Distressed sales, those that are either short sales or foreclosed sales, accounted for roughly 1/3 of all the transactions and will likely continue to represent a sizable portion for at least the rest of the year. Why? Because mortgage delinquencies are still very high. Meanwhile, new home sales, which unlike existing home sales actually reflect contracts and not closing, rose 27%. Remember, though, that we are already in May and the home buyer tax credit has expired as of the end of April. So data collection for April is still taking place, and the figures are likely to be even higher. A nice uptick in the mortgage applications in April points in that same direction. That home buyer tax credit did exactly what it was intended to do. It spurred home sales, especially among first-time home buyers. In fact, first-time buyers accounted for 44% of home sales in March. Despite all the chatter about their heavy presence in the housing market, investors made up only 19% of all buyers. And that 19% share is about the historical norm. What is out of the norm is the proportion of all cash purchases. As has been the case for several recent months, 1/4 of all the buyers in March made their home purchase without financing. Okay. In normal times, all cash purchases would make up about 10% of the transactions. So it's about double right now. Home prices are recovering as well. The median transacted existing home price squeaked up almost a 0.5% gain in March compared with 1 year ago. New home prices averaged 4.3%. So another increase. Surprisingly, housing inventory, despite higher sales activity, has been rising. And that's because fresh listings have been rising faster than the existing inventory has been absorbed. A combination of foreclosures, short sales, and homeowners who have not wanted to sell during the depths of the downturn last year are evidently contributing to the supply. There were about 3.6 million existing homes for sale at the end of March. In addition, there are still too many vacant houses. The best estimate is at about 700,000, which is above normal levels. But the new home inventory of 228,000 units is the lowest level in 50, that's right, 50 years. So that obviously does have some good effect on the resale market. The very depressed housing starts have actually helped to chip away at the inventory of newly constructed homes. Aside from home builders who are concerned about competing with deeply discounted, distressed existing homes, builders are also encountering a problem of being unable to obtain construction loans. Even so, broadly speaking, the inventory overhang will be with us and hold annual home price growth in the low single digits for at least 5 years. Some local markets, there's that all that real estate, is local mantra again, which we've said before. However, will easily surpass national growth rates and could see double-digit price growth this year and next year. One region poised for better price gain is the low local inventory markets in Southern California. Hooray! Which is where we are. Now that the housing market is truly on its own, what can we expect? In the immediate months following the tax credit expiration date, home sales will definitely slide measurably lower. By autumn of 2010, it will be up to job creation and consumer confidence to do the trick in supporting the housing market. Another potentially big demand source is from improving funding for jumbo and second home mortgages. These segments of the housing market were essentially shut down last year because these mortgages did not have government backing and the banks were scrambling to boost their capital to be basically well beyond their stress test levels. As a result, we saw much bigger swings in the second home market. Second home sales in 2009, for example, were down 55% from their peak level in 2005. Primary home sales, meanwhile, declined by only 23% over that same period. The good news is that the recent past months steadily improving signs of increased lending for jumbo and second home mortgages have been appearing. That's not at all surprising given the huge profits and much improved capital situation in the banking sector. Banks are steadily moving towards more normal lending activity, even to the sectors that do not have government backing. Therefore, there could be a nice swing back of high-end jumbo home sales and vacation home sales this year. But a new menace could derail the optimistic scenario. What is it? Greece. Not the movie, the country. That country, in short, is bankrupt. It's unable to raise revenue to pay for government spending, including pension benefits for many who have retired at the age of 55. The Greek government has been borrowing heavily to plug the budget gap, but investors are asking if they will ever get their loan funds back from the Greek treasury. Germany, in particular, is irate that its citizens, who typically retire at a much older age than do Greeks, are being asked to basically provide pension money for the Greek citizens. In the meantime, Greece is ready to ratchet up the argument by blaming the crisis on foreigners, of course, and greedy lenders. So how do such events in a far-off land impact the U.S. housing market? If Greece defaults, then German and many other banks will see their capital evaporate. That in turn will make it difficult to lend to other countries like Portugal and Spain to finance their huge budget deficits. If Portugal or Spain also defaults via the situation, then another major credit crisis is on hand. Ireland would have been included in this list of potentially troubling countries with unsustainable government debt, but the Irish decided to dramatically cut salaries, furlough many government employees, and convince its investors it will repay the loans. Global financial linkages assure that the U.S. banks will also take some hit in their capital buffer. Jumbo and second home mortgages, goodbye. At the moment, the potential for the spread of this is all the way to the U.S. is a small probability, although it would be highly significant if it were to occur, of course. Finally, there's the oil spill in the Gulf of Mexico. As of the writing of this article in early May, it's still too soon to accurately assess all the wreck that will eventually materialize. It may be years before we really know all of the effect of the local economies to get back on their feet. For the broader U.S. economy, the oil spill will mean two things. One, the price of oil will rise measurably, or more imported oil will have to be brought to the U.S. In both scenarios, economic growth will be held back. If oil prices were to rise to $100 a barrel and stay there, then GDP growth would likely be reduced by 1 percentage point. GDP growth of 1.9% rather than the current forecast of 2.9%. If more oil is imported, then the net export equation deteriorates. So, slower economic growth would mean slower job expansion and a higher U.S. budget deficit. Neither one of those results are positive for our economy or real estate. So it's a waiting game. Enough for real estate today. This is Duane signing off. Happy trails to you. As always, proud to be an American. Thank you for joining us.